So you've got $50,000 ready to invest for the long haul, and you're facing that classic financial showdown. Do you buy a real, tangible property that kicks off some income, or do you put that cash into the kind of abstract world of the stock market? This is a huge money decision, so let's really break it down.
And this isn't just theory. We're going to run the numbers on a 20-year experiment to see which path not only builds more wealth, but also what's the real cost in time, in stress, and in risk. The answer, it might just surprise you. All right, let's dive in and meet our two investors. Picture this. They're the same age, they make the same salary, and they're starting from the exact same place. 50 grand ready to go.
So, meet Jake. He goes the real estate route. That $50,000, it's the down payment on a nice little rental house. And instantly, he feels like a genius, right? He's got keys, he's got a tenant, he's got a great story for dinner parties. Then there's Marcus. He takes the same 50 grand and just puts it into an index fund. He gets a confirmation email, that's it. His coworkers are not impressed. On day one, Jake feels like he is winning by a mile. But as we're about to see, feelings and math are two very, very different things.
Okay, so Jake's investment feels real, it's tangible, and it feels super smart. He's collecting rent checks, watching his property value go up, but the math that real estate influencers love to show you online, it's often missing a few pretty crucial lines.
On paper, the numbers look great. Jake charges $1,800 in rent, his mortgage is $1,330, and that leaves a neat $470 in his pocket every single month. That is the number everyone brags about. But honestly, it's a fantasy.
The reality is, a property is basically a machine with a lot of breaking parts. You've got vacancy. The average rental sits empty about 1 month a year. You've got property taxes and insurance. And then you have the big ones, maintenance and these things called capital expenditures. And these aren't just little surprises, they are guaranteed future costs. A roof, an HVAC system, a water heater, they all have a shelf life, and replacing them costs thousands of dollars at a time.
And this is exactly what financial expert Ramit Sethi is talking about here. He says most people never factor in all the phantom costs. See, when you just ignore these guaranteed expenses, you're not really running a business. You're just running on luck. And the math, it just doesn't work.
And here's what that actually looks like. Over the first 3 years, Jake's glorious $16,920 in on-paper profit just vanishes. After he pays for a new water heater, fixes a roof leak, covers taxes, insurance, and deals with just 1 month of vacancy, his actual take-home cash flow is closer to $3,000. That's for 3 years of being a landlord. It's a part-time job that pays less than babysitting.
Now let's see how this builds, because while Jake's cash flow is getting crushed, he has one massive advantage working for him. At the same time, Marcus has a different, much quieter force that's just starting to build momentum.
Jake's secret weapon is leverage. Think about it. He used $50,000 of his own money to control a $250,000 asset. So when that property appreciates by, say, 4%, he's not making 4% on his 50 grand. He's making it on the entire $250,000. That's the power of using the bank's money, and it's something stock investors just can't easily do.
And this chart, it brilliantly shows Marcus's engine, compounding. It's kind of boring for the first 5 years, and then it gets almost scary for the next 15. His returns start earning their own returns, and that growth curve just gets steeper and steeper. The machine starts feeding itself, growing faster than he could ever add to it manually.
Okay, let's fast forward a decade. After 10 years of late-night calls for Jake and complete silence for Marcus, the numbers deliver a pretty shocking plot twist.
Get this, after 10 years, they are essentially tied. Jake's net worth is built on appreciation, leverage, and hundreds of hours of his own time and sweat. Marcus's is built purely on market growth and patience. But look at the non-financial side. Jake is carrying a massive 6-figure debt and has poured his life into this one single asset. Marcus, he has spent 0 hours. He's literally done nothing.
So they were neck and neck at the halfway point. But you'd think the second decade is where the real power of these two strategies would kick in, right? So, after another 10 years of compounding and appreciation, does a clear winner finally emerge? Let's take a look at the 20-year verdict.
20 years later, they've both created incredible wealth. No question about it. Jake's property, now with a ton of equity, puts his net worth somewhere between $450 and $580. Marcus's hands-off index fund has compounded to a value between $420 and $460. Look at those numbers again. 2 wildly different paths, 2 radically different levels of effort, and yet
a surprisingly similar outcome. It's almost a tie.
So this is maybe the most crucial point. The final number isn't the whole story. The real difference is what each of them paid to get there. Jake paid with time, with stress, and with risk. Marcus, though, he had to pay a totally different price. The sheer psychological terror of watching his portfolio get absolutely crushed during market crashes and doing nothing. I mean, think about 2008, when the market dropped 37%. Can you imagine watching nearly 40% of your life savings vanish in a few months and having the iron will not to sell? The data is crystal clear. Most investors fail this test. They panic, they sell at the worst possible time, and they lock in their losses for good.
Now look, this doesn't mean real estate is a bad investment, not at all. It's just a misunderstood one. Because under the right conditions, a rental property can absolutely demolish the returns from an index fund. You just have to know the cheat codes.
First, there's house hacking. You live in one unit of a property and rent out the others. Basically, you have your tenants pay your mortgage while you build equity. Second, you can follow the 1% rule. This is just a quick test for cash flow. It means the monthly rent should be at least 1% of the purchase price. So a $200,000 house needs to rent for $2,000 a month to likely cover everything. And third, there are these amazing unique tax breaks. Things like depreciation or a 1031 exchange, which lets you sell a property and roll the profits into a new one without paying taxes right away. These strategies completely change the math.
Okay, let's bring this all together. What does all of this mean for you and your $50,000? Well, if you start looking at the long-term data, you'll find a very, very confusing picture.
On one hand, you've got data showing that since the 1970s, the stock market has significantly outpaced the growth of residential property values. Yeah, it's more volatile, but the long-term trend isn't even close. Stocks win.
But then you have this massive academic study that looked at data all the way back to 1870, and it concludes the exact opposite, that residential real estate has actually been the best long-run investment, delivering similar returns to stocks, but with way less volatility.
So who do you believe? Decades of recent market data or over a century of economic history? It seems impossible to get a clear winner. And maybe that's the point.
This was never really a choice between two assets. It's a choice between two different forms of payment. The price for real estate wealth is paid in time, in labor, and in stress. It's paid on weekends fixing a leaky faucet and on late nights screening tenants. The price for stock market wealth is paid with emotional discipline. It's paid by watching your life savings evaporate in a market crash and having the stomach to stay the course. The better investment isn't the one with the higher return. It's the one whose cost you're more willing to pay.